Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Healthcare Services Group, Inc. Annual Report. Healthcare Services Group, Inc. offers a wide range of businesses and services to various healthcare facilities across the United States. At its core, the company provides management, administrative, and operating services to housekeeping, laundry, linen, facility maintenance, and dietary service departments. The housekeeping segment is responsible for cleaning, disinfecting, and sanitizing resident rooms and common areas, as well as laundering and processing linens and uniforms used in facilities. This includes bed linens, personal clothing, and other assorted items. In addition to housekeeping services, the company's dietary segment manages customers' dietary departments, focusing on food purchasing, meal preparation, and professional dietitian services. This includes developing menus that cater to residents' specific dietary needs and providing on-site management and clinical consulting services. The company serves long-term and post-acute care facilities, hospitals, and other healthcare industry clients through referrals and targeted solicitations. With a presence in the United States since 1976, Healthcare Services Group, Inc. has established itself as a trusted provider of comprehensive healthcare services. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what could cause a stock price to skyrocket in the past year. The stock price of Healthcare Services Group, Inc. has seen a significant surge over the past year, leaving investors and analysts eager to understand the underlying factors driving this trend. One possible explanation is the company's strong financial performance, including robust revenue growth and improved profitability. This could be due to various factors such as increased demand for healthcare services, effective cost management, or strategic acquisitions. Another potential reason for the stock price increase is the company's expansion into new markets or geographic regions. By diversifying its operations and increasing its market share, Healthcare Services Group, Inc. may have gained a competitive edge over its peers, leading to higher investor confidence and increased demand for its shares. Additionally, changes in industry trends or regulatory environments could also contribute to the stock price surge. For instance, shifts towards value-based care or increased focus on healthcare technology might create new opportunities for companies like Healthcare Services Group, Inc. to innovate and grow. Lastly, external factors such as market sentiment, economic conditions, or sector-wide trends may also be influencing the stock price of Healthcare Services Group, Inc. As investors and analysts continue to monitor the company's performance, it is essential to consider these various factors when evaluating the underlying causes of its stock price increase. Healthcare Services Group, Inc. maintains a market capitalization of $2 billion, broadly in line with the industry peer group. Healthcare Services Group, Inc. trades at a higher price-to-earnings ratio of 27 times and a lower price-to-book ratio of 2.98 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 38% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, service agreements with new customers, retention of existing services, modest price increases, population aging, government reimbursement policies, referrals, industry trade shows, advocacy associations, changes in Medicare and Medicaid funding rates, investment income, and ERC refunds all contribute to revenue growth. However, there are also drivers that lead to revenue decline. Genesis Healthcare's bankruptcy, changes in government regulation and reimbursement rates, disruption or delay in Medicaid payments, and fluctuations in stock price due to temporary market perceptions can all negatively impact revenue. Furthermore, certain factors such as changes in wage rates, EVS labor costs, fluctuations in EVS and dietary supplies, and legislative changes affecting government reimbursement for nursing home services also play a role in revenue growth or decline. In terms of specific revenue streams, environmental services revenue increases are driven by increased facilities serviced and contractual pricing, while dietary revenue increases are driven by organic growth, pass-through costs, and contractual pricing. Overall, the drivers of revenue growth or decline are complex and influenced by various internal and external factors. The net income of the company underwent significant fluctuations between 2024 and 2025. Initially, it decreased due to increased credit losses and reduced revenues from customer bankruptcies. However, this trend was later reversed, as net income increased by $19.6 million and 39.1% respectively during the same period. The decrease in net income can also be attributed to increased labor costs, regulatory changes, and potential tax liabilities. The profit margins of the company were adversely affected by market interest rate increases and potential reductions in reimbursement rates. Additionally, increased labor costs, regulatory changes, and compliance costs further negatively impacted profit margins. Nevertheless, a notable increase was observed from 2.3% to 3.2% between 2024 and 2025. This trend is also supported by the fact that net income increased by 53.5% from 2023 to 2025, implying a potential rise in profit margins. The company's financial performance has shown a significant improvement in its ability to generate cash. One key indicator of this is the positive operating cash flow it has achieved. According to the latest figures, net cash from operating activities for 2025 stands at $144,968. This is a notable milestone for the company, as it demonstrates that it is now capable of generating sufficient cash from its core operations to meet its financial obligations and invest in growth initiatives. The positive operating cash flow also suggests that the company's business model is becoming more efficient and profitable over time. The company's debt level has experienced a slight decrease over the past year. According to the extracted summaries, the debt level decreased from $50.8 million in 2024 to $47.7 million in 2025, representing a reduction of approximately 6%. Additionally, there were further decreases noted on pages 63 and 64, with a total reduction of around 3.9% over these two periods. In terms of interest expenses, the company has seen a significant decrease. The interest expenses decreased by 75.5% from -$6,438,000 in 2024 to -$1,580,000 in 2025, indicating a substantial reduction in the company's financial burden. This trend is consistent across multiple pages, with decreases ranging from 74% to 75%. Overall, these changes suggest that the company has made progress in managing its debt and interest expenses over the past year. The company's performance varied across different segments and regions. On the positive side, the Environmental Services (EVS) segment saw a significant increase in revenues of +7.7%, while total segment expenses decreased by 1.1% and labor costs decreased by 0.1%. The North region also experienced revenue growth from $11.2 million in 2024 to $12.8 million in 2025, as did the East region with a growth from $13.5 million in 2024 to $15.3 million in 2025. In contrast, some regions and segments underperformed. The dietary segment saw an increase in total segment expenses of 2.3%, while labor costs increased by 2.2%. However, supplies costs decreased by 1.6%. The South region experienced a revenue decline from $7.8 million in 2024 to $9.1 million in 2025, as did the West region with a decline from $6.9 million in 2024 to $8.5 million in 2025. The continental United States region was mentioned as a significant market for the company, providing services to approximately 28 facilities, but no specific performance metrics were provided. Overall, while some regions and segments showed improvement, others struggled with declining revenues or increased expenses. Management statements about the company outlook and strategy reveal a focus on growth through various means. To achieve this, they plan to obtain new service agreements with customers, provide new services to existing ones, and implement modest price increases on current agreements. Additionally, internal cost reduction strategies will be implemented to maintain profitability. The company aims to prioritize customer relationships by maintaining satisfactory relationships with customers, focusing on operational excellence, employee development, and creating a positive social impact. This includes attracting and retaining top talent through competitive compensation and benefits packages. In terms of risk management, the company plans to mitigate labor costs in environmental services, negotiate fixed pricing with vendors, and focus on building efficiencies at the facility level. Financially, they expect to maintain satisfactory customer relationships and pass through cost increases to customers through service billing increases. Industry trends suggest that the market for their services will continue growing due to an aging population and government reimbursement policies requiring cost control. As a result, management plans to focus on long-term and post-acute care facilities, which are expected to grow significantly in the coming years. That concludes the financial summary for Healthcare Services Group Inc. Feel free to comment below, and I will be happy to answer them when possible.